All right, the market started off the post-holiday kind of Santa Claus type rally period, seasonal period with down days. Like this is a third down Monday in 4 weeks after having like 17 out of 18 to the upside. So quite the move, quite the change. Now, granted, all three of these Mondays have been really light, and today was probably the lightest of all, especially in terms of total range and total volume. I mean, it's almost like we had another Friday after Thanksgiving today, but it was a full day today, but very little movement, and we'll talk about kind of why we're getting so little movement and what kind of move this that we've gotten over the last 20 days, especially in light of the fact that we haven't gone anywhere over the past so many. So we'll break that down in today's video. We'll also take a look at what's driving the weakness today, the relative weakness today, weakness, and especially in terms of just no movement. There was some moves, and we'll see, what has been driving a lot of the bullishness and how likely is that to persist going forward. And of course, our Black Friday sale has been extended throughout the rest of the week, the Cyber Monday into the Cyber Week. Again, it's a good deal. I break that. I'll show you here later how to sign up for that. It's our most popular sale of the year. That's why we generally get tons of signups over this weekend, and this year has been no different. So we decided to push this out through the rest of this week to be able to make sure that everybody, especially those who have been having questions over this weekend, can be able to get that taken care of. With that said, let's go ahead and get started. Today is Monday, November the 27th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, some popular posts that we have here recently on our site. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. The more you do that, it helps get our content out to all of our followers on those platforms. Also, a reminder, too, that we do have our Black Friday sale going through the rest of this week for Cyber Monday, Cyber Week. This is the first comment on today's Market Outlook, so you can just check that out at the bottom. Again, you click on this link to sign up. You can click on this link to get more information on the deal. If you go to our pricing page, you can see what we offer to all of our premium subscribers. I mean, at normal price, you're getting about a 25% discount to the monthly subscription, and in addition to everything you get that the monthly subscribers don't get. So that's a good deal in and of itself. But with the 20% off Black Friday, you're paying about almost $77.75 a month for the 3 years, compared to, again, $129 in addition to everything. That's why it's our most popular sale of the year, and that's why again, it was very well received again over the weekend. And we thought because of the demand for and a lot of questions that people had, we thought we'd keep it going for the rest of this week. So that everybody can be able to sign up. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, another quiet day. We had a few. Now, Fridays, of course, it's a quiet day, right? It's after a holiday, though there have been Fridays after Thanksgiving that weren't so flat and quiet, but for the most part they are. And you can see Thursday and even Wednesday and Tuesday are pretty quiet too. Last Monday was a really good Monday. The Monday before was kind of a small down Monday. This is kind of the second Monday in a row we've had a down day, so that we've kind of breaking the streak of all the up Mondays that we've had this year. Though, again, all three of the past 4 Mondays have been down, but all three of them have been marginally lower at best. Down 0.2% is all. Down nearly 9 points. I mean, the momentum line's down, but the momentum line's down that low because of the small ranges. The ranges have been minuscule. I mean, look at 14 points on an average range of 42 for a full day's worth of trading. I mean, that's minuscule trading range. The near-term line's now coming down again because we haven't been going up anymore, but it's not in bearish territory. We've already had, technically, the near-term runs last this whole time, because even didn't get the near-term line into bearish territory. So it did drop it below 50 briefly, but not in the bearish territory. So this has been one big long near-term rally, which is typically 7 to 12 days. Of course, it's been now 20 days. So a little bit longer than normal before the near-term line makes its way into the reversal zone. In fact, it's been a while since we've had that long of a run. This run lasted quite a while. I don't know if it lasted a full 4 weeks, but this one, you can see the near-term line got up. We had a little dip to below the 50th percentile before falling back into these bear tags. So they can last a while. It's just that, again, this has been a long time. And of course, as we all know, in a very extended move to the upside, as you can even, again, with the rate of change now at 20 days, even with how sideways we've been for the last really 3 of these 20 days, this is still a large move over a 20-day time frame. And it really 19 and a half, but if you look at it there, you can see it's not unprecedented to be over 10% on 20 days. In fact, we've had a couple of these here and within the past year, but and like I said, all these others, including these moves here off of the June and especially the October, like the June especially, was when we've had the biggest washout in terms of breadth and everything in the markets. And of course, you had a huge washout in both of these two corrections. Not nearly as much of a washout here, though similar type of move over a small amount of time. So it's not surprising the near-term line would come down. You can see where we've kind of hit that 5% limit up above the 30-day moving average. Again, we've done that. We hit 5% above it over here. We got to 5.16. We got over here to 6.1%. And those ended up being some peaks. And we didn't quite get to 5. We got to 4.92 and 4.84. And now, pulling back a little bit and see if we ultimately end up pulling back below that 2.5% mark above the 30-day moving average or not. So that's the S&P 500. If you look at, of course, the Russell 2000, which hasn't been nearly as bullish, then you can see, okay, well, coming off of this move high, remember the S&P is close to the 100% retracement. The Russell is not close to the 100% retracement. It's not even above the 50% retracement, barely above the 38, and not nearly as bullish on the near term. Right, we've had a couple near term dips there below the into bearish territory, and the intermediate lines barely above the 80th percentile. Market sentiment the market sentiment has now crossed above the 20th percentile there, so not nearly as bullish on the Russell 2000. Of course, the Nasdaq did clear these highs. Is up to new 52-week highs here, though its near-term line has dropped in the bearish territory. And of course, when the intermediate line's in the reversal zone, this is actually a bullish intermediate confirmation signal, a much better one than what we saw on Thursday or Friday, when the near-term line's finished above the chart's midpoint. But now that it's below, and you have another day of oversold momentum line, this is the ideal setup. So again, considering that we're just flat here, but this is generally a good bullish signal. The issue is, again, we've had this big near-term rally, and this is all the near-term pullback we get. If this is one big near-term rally, and you notice we're not even close to the 23% retracement where an actual retracement starts. So if we bounce back up from here, which is what you would expect with this signal, I would not expect a big another 20-day. Again, it's typical 7 to 12. So I wouldn't even expect a 7-day to come out of whatever we bounce up, if we bounce up, because again, we didn't even get to the 23%, much less below it, which is what you need to get a retracement going. And not only that, we didn't even get close to the 23% retracement. So hardly any kind of pullback there at all. And then finally, your Dow Jones Industrial Average looks very similar, though it's, again, intermediate confirmation signal. But the near-term line is not only, not below the 50th percentile, it's not even out of the reversal zone. So, again, that worked out over here and worked out over, this one did get into the bearish territory and this one didn't. And both of those intermediate confirmation signals worked out. And again, like I said before, we've had 2 near-term rallies over the course of the one the S&P has had. You probably wouldn't expect a big new rally to occur from today, considering that hardly. At least at least here, when you look at like this near term, the first near term rally that we had, right there, you can see it at least got close to the 23% retracement before starting. But again, it generally has to get below 23 to actually have a retracement start. So it's kind of like the S&P. I mean, for the S&P 500, this wasn't a near-term pullback. You know, its near-term line did not get into the bearish territory, so you could probably argue that really wasn't one either. And this is all one big, very long near-term rally that at some point in time, it's, you know, again, the near-term line doesn't stay above 50. It's an oscillator. It doesn't stay in the upper half of the chart forever. It's going to work its way into bearish levels. It's just a matter of what kind of pullback we get when it does. Let's take a look at now the weekly chart. As you can see, we're getting another good bullish candle. The size of the candle is now below its average, so the size has dropped to below the average there. Obviously, we're not at a 3% anymore. It's hard to stay at 3%, as you can see. It's a few in August. We had 1, 2, 3, 4 above 3%, but that's not common. It's usually you get a couple above 3%, and usually again in the midst of corrections too. So that is a sign of weakness that we are below the average, the 3-day average there, and then again the other sign of weakness as of now is the lower high point. We're getting a higher close, but the lower high point. So let's keep our eyes on that over the course of this week. If you take a look at the 3 green arrow chart, of course, we have 3 green arrows up here. All across the board, we have 3 green arrows. So the MACD is getting really close to a red arrow on the NASDAQ. So we've had the surge, and this is the first stage of convergence when you are, when the histogram is falling. The second stage of convergence is when you get the red arrow, because usually it's the MACD that gets the red arrow first, especially when the stochastics is in the reversal zone and you're this far up above the moving average. And of course, you really see the convergence here. So, you know, again, the convergence is when the MACD gets below its moving average, but we're still above the 17-day, which is, we are clearly still above the 17-day. We're not even close. This is one of the stronger momentum moves that we've seen in a while. And so we are still, you know, we got up to 4% above the 17-day. But you can see it's crossed over, though we're still above the 17-day. So in that regard, we are in convergence mode, and we're pretty much close to convergence mode on the regular 8-17-day that we use. But you see how high the MACD got, the highest of the year, and the histogram has been falling pretty sharply there. Looking at the some of the other oscillators, the DMI, of course, is still at bullish levels. The ADX now is above 30 and is rising. We're still well above 30 on the positive, well below 20 on the negative. Remember, that's the S&P. The Russell's not so bullish. We are still above 30 slightly on the positive, but not below 20 at all on the negative. Looking at the let's see here, some of the other oscillators. Look at the RSI and the CCI. Remember, we've been talking about this. We don't have that confirmation between the daily CCI getting above 150 at the same time the RSI gets above 70, especially with the weekly CCI getting above 100. So, you know, you get above 100, you kind of stay above 100, but that usually includes at the same time that we get these moves where we cross above 100, we usually get a move above 60 and above 150 on this daily CCI to help confirm it. Even if we pull back slightly after, that's okay. But we haven't quite gotten that move yet here, especially with the CCI on the daily not confirming it at all. Then you look at the Ichimoku cloud, again, strong move. We got a mature trend strength. So when you got a mature trend strength, it usually creates a gap between the blue and the green line. So the first sign of weakness is getting below the green line. So we'll keep our eyes on that, especially considering we got the green crossover. So now the question is, are we going to stay above the cloud by the time we get there? That's something to watch for. IWM just barely got the green crossover, and we're not above the cloud, right? We're actually in the cloud. There is an intermediate trend strength going, but, you know, again, not nearly as strong as what you see on the S&P 500. And then finally, the Bollinger Bands are starting to come down on the S&P 500. We never did really stay. Of course, we never did get into above the 90th percentile to really push up that upper band. But we also didn't really stay in the upper quartile very much. We're already below that upper quartile, have been for the last few days. And you can see the momentum, which has been extreme here, is already faltering but still above the Keltner channel. So the sign of weakness would be if and when we get back below that Keltner channel there. Looking at the 4-week range today, the intraday range, you can see just how sideways we've been. Very, very sideways. Of course, Friday makes sense that we were so sideways, but today and Thursday, not really, and especially in Wednesday and Tuesday of last week, not really. So we did not get a new high point. The high, we're coming down. We've already hit zero on the negative. We're coming back below that 10% mark because the low point's starting to move up, and it will gradually move up more and more as we don't produce a new high. So kind of watch for this green line over the course, because by the end, if we don't get a new high point by the end of this week, then the green line will cross below 70, and that sets us up for, because by the end of the week, your high point will be 1, 2, 3, 4 more days, and after Friday, it will be all the way up to the 432, the midpoint of the current range. So that's how fast the range will tighten up. So if we don't get a new high point, and there's not very much support down below, last week's low point. If we flirt with last week's low point, we could be flirting with, by the end of the week, the 4-week low by the beginning of next week, and not really be that big of a move to the downside. That's how crazy the first surge was, and then how slow the last part of this 20-day run has been. Finally, looking at let's look at the volume today. As I told you, the range was really small. The volume continues to be really small. So there's the range. So now you put those numbers in context. The relative ATR has plummeted. It has plummeted without ever getting above 1.5%, which is typical for pullbacks, much less a correction. And this was very early stages of a correction. It was a correction on the Russell. But the fact that, look at that. The range has plummeted down to well below 1%, and the volume has plummeted. So really things have been tapering off. Again, kind of goes to show that we haven't overwhelmed, the sellers haven't overwhelmed yet, but we've definitely run out of buyers. It's kind of what you're seeing. And then finally looking at the volatility, it's extremely low. Again, still well below 13. It's been below 13 a few times, well below the 85% mark. But the last time it got below 13 was over here before September expiration. You saw what happened during that expiration cycle. That was over here, and you can see we had a dip below the 50% mark going into that. We have a dip below the 50% mark again twice going into this one. We kind of had two going into that one too. So the VVIX is suggesting, there's a widening gap there. The VVIX is suggesting that we might be getting a pretty decent sized move the last time we dropped below 13 coming up on the VIX. So something to keep an eye on heading into what is seasonally not a bullish time of year for volatility, but considering right now this seasonality is again, we typically falter here, but considering volatility is already at the lows of the year, and that's not typical for this time of year. This time of year, you can see volatility is a lot closer to its highs than it is its lows of the year. So we might, how much of this seasonal drop in volatility have we already pulled forward? Again, to get up above that July low point, we can, jump up into this area on the VIX and still be kind of seasonally true. So that's kind of something to keep, again, we can get a pretty decent move in volatility and buck the seasonal trend and actually still keep the seasonal outcome. When you look at it from that perspective, because we may have already pulled forward that drop in volatility already. All right, the sector, the asset class comparison chart shows, obviously a very common expected pattern. Everything's been rallying for the past 4 weeks to the tune now the Qs are up, 7% over the past 3 months. The dollar's still up a little bit. The commodities are now negative over the past 3 months, and bonds, which are way negative at one point, are now not so negative, right? That's probably your, of course, those are your biggest drivers of what's been going on. That actually, a little bit of a driver today. The bond yields were down again pretty hard today after ramping up on Friday. So a little bit down from Wednesday's close, which is kind of makes sense. But you can see the MACD histogram has been moving towards zero as the MACD itself is at relatively low levels, not the lowest of the year, but low levels here. We're sitting on the Fibonacci retracement level Obviously, still below the 17 days, so no convergence there. But we're in that first stage of convergence again, where the histogram is moving towards zero, and we're close to getting a crossover on that. So that's kind of one of your biggest movers. Of course, your other big mover is your dollar. The dollar was down a little bit today, so there's the dollar's move right there. So again, below the 200 days. So this is now the 1, 2, 3, fourth day we've closed below the 200 day. The 8 day now is crossing below the 200 day. Again, right as the histogram has been moving up. Again, first stage of convergence there. And slightly below the 50% retracement of the run. And then finally commodities, and we'll use commodity index here. But commodity is sitting on its 200-day moving average. Again, you can see since that, here's the October 27th time frame. From this point, we've been on the steady decline, flirting with the 200-day, flirting with the point of control. And you can see the MACD is not nearly as low, but diverging, a divergent low point with these lower lows that we've gotten. And the stochastic is above its moving average. So the question, of course, is how much further do these three things have to fall? Because the drop in all three is what's really been propelling most of this market move, and especially in the Qs. And any kind of rebound in any of the three or all three would obviously put a damper on this tremendous rally that we've had to the upside. Of course, breadth, we haven't had very much of a move, so breadth has been tapering, though we are back above zero. So we'll see, how much further we can get back above positive 100 or not, or positive 500, excuse me. So breadth has been looking a little bit better from that perspective. The new highs and new lows index, again, you see how it can't quite get above 100, so we can't really break through with new highs. Of course, part of that, the reason is like we're kind of peaking here at how many stocks are continuing to move higher, like above the 50-day moving average. Look how fast the moving average is ramping up here. So we're peaking there, and this is about the level we peaked over here last year. Of course, if let me zoom out a little bit, because if we've been comparing this move to the March move, and the March move we got about to this level and got to where the average got up to about 300, and we're going to be getting there pretty close. Of course, the August was a lot more, and you see that in the number of stocks above the 200-day moving average. We were last August right here. The March move got us up to 300. The last August move got us up above 250. So here we are again, about the same level, and looking like we're peaking on that too. The skew has been pretty strong for the most part. You can see still well above 140, which is a very high level for the skew. Above its moving average, though we're not, we're not trending up because we're already so high. So that's the kind of concern here about how much further we can trend higher if the skew is already as high as it is. You can kind of see we did, again, let me go back a little bit further. In 2021, at the beginning of this year, it got up above 150 and stayed above 150 for a long time. Of course, the market was worried about what happened in 2022. They were just worried about it 9 months earlier because the Fed never started to raise rates until back over here in the March. I think the market was worried about the Fed options market here, worrying about the Fed doing something a lot earlier, which never happened. And then you can see eventually it did. And but by getting above 140, it's a high level you can see that's about how high we get at all these other major peaks that we've had. So here we are again, and so it's hard to trend up when you're already here, when you're already so far up, and the average for that matter is already almost above 140 itself. If you look at the sector moves here, so let's look at the sector comparison chart, and again we'll look at just today alone. Let's go to November 27th. You can see, again, it's, for the beginning of this run, it was all about, sorry, I have to go back a little bit further. For the beginning of this run, it was all about the XLK, XLY, XLC. You can see XLC it was the worst performer the last couple of days. XLK has also been relatively negative for the past couple of days. And then XLY is lagging behind real estate and utilities, doing well with yields coming down. Materials up there, energies up there with dollar sensitivity doing well too. and staples are almost matching the performance of XLY. So, not quite the strong bullish move. Again, if I were to zoom all the way out to when this whole thing started, this whole 20-day cycle has started here. So we'll go back to October that 27th. Then you can see it, XLK, XLY, XLC. Financials have done really well too, 12%, and real estate's been doing really well as well. Everything up except for energy, which has been flat over this cycle. That's caused pretty much all of these sectors to show some very strong patterns here on this chart. Again, dark green shading and a green line on the S&P, dark green shading and a green line everywhere else with some pretty strong numbers, relatively strong numbers. XLK is up 8% 3 months. XLC is up almost 6.5%. XLY is up 2%, and then everything else, I mean, these are all negatives. Financials are up 3%. There's a negative, 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 negative. So dark green shading and green line, but all negative 3-month returns still. And energy, of course, has a dark pink shading and a red line still, and has the biggest negative decline over the past 3 months. All right, now let's take a look at our trade idea of the day, and it's on Union Pacific. You can see Union Pacific's also had a nice little 20-day run off of that October 27th low point, got up to a cluster. But then today is kind of the biggest drawdown that we've seen, a big move to the downside, down 2%. It's got an intermediate confirmation signal. The intermediate line is still above the 90th percentile, much less the 80th. But the near-term lines is barely below the 50th percentile. It'd be better in the bearish territory. Oversold momentum line, you can see the engulfing pattern, multiple bodies there. If you take a look at its long-term, its weekly chart, we got the bullish candle, but you can see it's a much smaller surge than what we saw over here, and we're already breaking below the moving average on the size of the candle. Higher close, but lower high point. So you can see the signs of weakness that are developing. Not bearish signs, right? I mean, these are hardly bearish, but we're below the 8-day moving average. We just kind of lose that bullish momentum when when we're starting to, when we've been so strongly bullish and then we're not. You can see we're back below 30, almost back above 20 on the negative DMI, negative directional index. Back below 60, back below positive 100 on the CCI. Looking at the Ichimoku cloud, again, you can see an intermediate trend strength. The rate of change, you can see we're above the cloud, so starting to lose a little bit of momentum, even though we're still above the green line. And then finally, out of the upper quartile on the Bollinger Bandwidth, that is now rolling back over. We're in the upper 2/3, but in the upper half especially, but not in the upper quartile anymore. And you can see the momentum starting to turn over as we're not above the Keltner channels anymore. So the kind of move you would expect the market might end up producing here sooner rather than later. So considering how bullish it is and not really like how bullish it's been, but and ending that bullishness, but not really getting too bearish either, what I decided to do was to come over to and do a iron condor spread, selling the low 20 deltas on both sides, and then buying one strike away for protection either side. So that's where it puts. That's a full position size, a decent return. And you notice it puts our break evens, up here for some more room to run to January expiration if we do bounce off like the 30-day moving average and rally up, or if we do pull back, there's some pretty strong support at this volume as well as the 200-day moving average. And I don't expect a major pullback unless things really go out of hand with the markets. You don't expect a major pullback there, but you do expect enough weakness that we're not going to take off through this upper band here, which is where we gapped up to and failed before. So that sets us up for a pretty decent return to try to make about half our risk if we kind of stay in this area here, which would be the expectation with the Bollinger Bandwidth starting to decline. All right, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at Market Scholars for free. Follow and like us on Twitter and Facebook as well. Remember, we do have our Cyber Monday deal going throughout the week, so take advantage of that. Have a great rest of your week or Monday night, everybody, and we'll see you all next time.